Hey, everybody. Welcome to our special edition of the post-market briefing. It is Monday, April 13th, 2020. Today's show is going to be a little bit different. It'll be a little bit longer, a little bit more interactive, at least in terms of seeing the screen. So if you can get to a computer, I would highly advise it. We're going to be looking at kind of a macroeconomic look at everything that's been going on. And obviously, there's quite a bit. That's why we're doing these calls. As a reminder, we're doing calls every afternoon at 4:30 p.m. during the week, every morning at 8:30 a.m. during the week. Those are shorter, 10 to 15 minutes. So if this is your first time joining us, don't feel like you got to commit 2 hours a day. But we will be a little bit longer today as Ben takes us through some of his analysis, some of his thoughts, and we all weigh in on different topics. We appreciate you being here. As a quick reminder, this is not investment advice. We are investment advisors, but none of this should be used in your portfolios at your own discretion. If you have questions about things, give us a call. We're happy to chat about it, whether you're a client or not a client. Still happy to help you out. But again, this is not to be construed as investment advice. This is just a conversation about the topics at hand. Lastly, just wanted to give everybody a quick update just on the firm. If you're a client, you got an email today. We are going to be working remotely until April 30th. At least that's the standing order right now, given the shelter-in-place mandate in the state of Georgia. We're still fully functional. We're still rocking and rolling. We're really grateful to have a great team of people that are motivated, that are engaged, that are locked in. We're still communicating as a group pretty frequently, almost nonstop, maybe more than people would like in some cases, but we're still talking to each other, still going and still making progress as a firm. So we appreciate you guys being here and sticking with us during a challenging time. Last thing I want to say just before we get going is a quick congratulations to Melissa Visible. She is our financial planner at the firm. She just passed the CFP exam last month. So shout out to Melissa. Normally we would be congratulating her in person and making that introduction to everybody in the office. But since this is the most people we've had gathered in one place, I wanted to give her some props for that. It's a tremendous accomplishment. Melissa, if you have not met her, has been with us for about 2 years. She's absolutely excellent. If you have questions about financial planning or broader needs, please reach out to her. You can email her mvisbal@narwhalcapital.com, or you can email me, you can email Matt, Ben, Sam, Tom, any of us. We'll get you in touch with her. But with that out of the way, I'll throw it over to Ben, and he'll kind of take us on a tour, and we'll jump in and out of the conversation. And we appreciate you guys being here.
Yeah, thanks, Andrew, and thanks everyone for being on the call today. Obviously, we've been doing these quarterly reviews for the last couple of years now, so this is definitely the most significant one that we've had to do. I think last quarter's was pretty significant, but certainly not with the same declines in the market and still dramatically unanswered questions that are out there right now. So what we're going to do today is kind of talk about where we were going into the quarter, so January timeframe, and then talk a little bit about what COVID actually is, how it actually works, what the health response has been, what the economic response has been, and really kind of bullet point terms. So here's step 1, 2, 3 of what politicians are trying to do to contain the health crisis and the fiscal crisis. And then we're going to talk about what the impact of that actually is on the economy and where it's going. And I think that's really kind of why most of you guys are here. So with that, we'll just jump right back into it. I think the biggest thing that I want to kind of premise this all with is that I think the main question that I've received over the last 6 weeks is, when are we going to get back? When are we going to be able to get back to going to the store? When is the market going to get back? When is the economy going to get back to where it was in January? And the biggest thing I could do is actually push back on that question, because I'm not sure if that's the right question to ask. I think it's, how do we get through this? Because we still have a lot to get through, and getting back to where we were in January might not actually be exactly where we want to get back to. So let's talk a little bit about where we were. So in January, we had just finished 2019, and we actually saw employment growth in many states that were below trend over the past 10 years. So it was still growing, but the growth relative to what it had been below trend. So that's something to bear in mind. We also saw that only non-cyclical industries were growing above trend. again, above the trend of what had been for the last 10 years, which means that there was some slowing, especially in more cyclical parts of the economy, even exiting 2019 and beginning in 2020. You can see that with transportation and manufacturing, retail trade, all down versus their recent trend. The only things that were doing better were government, healthcare, social, these non-cyclical areas. You could also see this in the fact that initial jobless claims had stopped falling, which means that about the same number of people were being let go every week, which isn't to say that the economy necessarily had to peak, but the wages and employment tends to be a lagging indicator anyway. And so, again, we weren't seeing the dramatic declines in initial jobless claims that would be reminiscent of an accelerating economy. So that's what was happening at the end of 19. We also knew that revenue growth of the S&P 500 had been in decline for the last 5 quarters. And again, these are just copy and pasted slides from last quarter. So this isn't rewriting the past. This is what happened. And stock market obviously can go up in such a scenario because the idea was that we might not have 11% revenue growth every year, but we might have 5% growth, and maybe that would stabilize going into 2020. Obviously, that hasn't happened. So in the quarter, it wasn't just coronavirus. If we think back to the beginning of the quarter, we were talking about going to a war with Iran. Some media outlets were actually saying that we had effectively declared a war on Iran. I think those were a little, obviously, in hindsight, exaggerated. But that was definitely a story that was going on. Then you had the first real emergence of coronavirus in Wuhan. I remember talking about this in mid-January with people and now, to my regret, not taking it as seriously as I should have. These are definite conversations that were happening in January, and Wuhan was the epicenter, and it was being locked down. And then in February, Bernie Sanders became the nominee. That seems so long ago now, but especially now that he's endorsed Biden. But he was the front runner there for a little bit, and Biden had kind of fallen off the map. In fact, one of the implications of this was that health insurance stocks really got hit on this because a lot of health insurance stocks were down 10% or more when it seemed that Bernie Sanders was going to become the Democrat nominee. And again, we're a long way from that now after they coalesced around Biden on Super Tuesday. And then now we get into more than meat, and that is the OPEC collapse in the beginning of March. This is when Saudi Arabia and Russia basically said, we're not going to be able to do a deal. So instead of trying to do a deal, let's just pump as much as we can and take the U.S. out of the oil business. And so that's what their plan was. And that's changed a little bit. I think they got a little bit more than they bargained for. But oil plunged 24% for the worst day since 1991. I'm going to let Andrew talk a little bit about that at this point.
Yeah, and I think the big thing I would point out, as much as we've talked about COVID-19 and the impact on the economy, I think it's really important to understand that there are some major underlying storylines that have taken place over the last quarter. And oil, I would argue, is probably the biggest. I mean, this is just an absolutely vicious decline in price of oil per barrel, especially coming at a time where demand is not going to be high, given how many people are staying home, how many people are not traveling, how many people are not flying. And that in and of itself would be a major story that we would be spending hours discussing on a daily market briefing, so to speak. But because of the COVID-19 headlines, we spend more time talking about that. But you really cannot overstate the impact of the oil price on the economy.
Yeah, especially as the U.S. has become a net energy exporter over the last 10 years. And then you had the economic shutdowns. And again, if we think back to where we were at the beginning of March, there was just no real economies that were shut down. And then all of a sudden, by March 22nd, you had massive lockdowns all across the globe, in the US and especially in Europe and India, and China was emerging slowly from its lockdown, but it was still locked down to a decent extent. So all of a sudden in March, the economy shut down, and that was really what took the market down from its strong levels. Obviously, you saw the decline in the end of February, but a lot of people bought into that decline. It had been the Pavlovian response that people had been trained to do. You saw, Bernie Sanders might become the nominee, buy into that weakness. And then I don't think anyone was really prepared for the massive shutdown that happened throughout March. So in the first quarter, we began the year at elevated levels. We began the year at a growing economy, but not growing at the same place that it had been growing over the last few years. But even so, despite a number of negative headlines, that Pavlovian response was still tempted to kick in. And it wasn't really until the economy shut down that the market actually accelerated. And this is when you saw the 7% down days, the 10% down days, because there was massive uncertainty. And Andrew says this all the time, and it's very true. And that's, the market hates uncertainty. And there isn't anything more uncertain than predicting the trajectory of a pandemic, maybe projecting a hurricane, but at least a hurricane's isolated in terms of location. This is not isolated. And I think that's such a huge level of uncertainty that it scares businesses, and markets are just a higher beta version of a business. And so when, if you're scared as a business owner, or you just have a high degree of uncertainty and don't know whether to invest, then that's magnified on the investor side. So that's what we saw throughout March, and that's why the declines accelerated. So if we move forward to what coronavirus actually is, I think that the president has certainly taken a lot of heat for how he characterized it early. I don't think that is, obviously we can all rewrite the past, and things should have been shut down. But, it gets into the point of, are you going to run with 4 to 5 times the hospital capacity that you need in order to prepare for these once in 100-year events? I think a lot of people from a humanitarian standpoint might say, yeah, we can do that. But then when they're asked to pay 4 or 5 times as much for healthcare for 100 years, that becomes a tougher pill to swallow. So, it's important to adapt to these things very quickly and be able to flex your capacity very quickly, even more so than just carrying 5 times the number of ventilators you need. You need to be able to flex that rapidly. So coronavirus, if you look at the numbers, it's most similar in terms of transmission and death rate, and the fact that we don't have any treatments for it, to the Spanish flu. It has a much lower death rate than Ebola and SARS, a higher death rate than the seasonal flu and H1N1. And transmission is about the same too. So for every 1 person it infects about another 2 people. And the thing that is concerning about COVID-19 is that we don't have treatments, we don't have vaccines, and people with already fairly compromised immune systems seem to be the ones that are in the most dangerous situation. How does it work? So these are for survivors who have been admitted to the hospital and non-survivors who were admitted to the hospital. And you can see it's a fairly lengthy, drawn out process. Even if you make it through the hospital and survive, you're in the ICU for potentially 6 days. And so this is not an easy disease. It's not an easy virus. incredibly dangerous. And, even if you make it through, it's not a pleasant experience at all. So the solution for this. So we're going to talk a little bit about the healthcare solution, and we're going to talk about the economic solution as well. So the healthcare solution is pretty simple. You talk about demand. You want to reduce demand on the healthcare system, and you want to increase the supply of the healthcare system. And then on top of that, you want a treatment for it to reduce the impact if you do get it. So increase the supply, decrease the demand, so that you have that capacity to actually handle these cases. So in order to do this, you got to flatten the curve and spread the impact over a longer time period. And you do that by better testing and social distancing. These are things that we've heard all the time, but we don't always see the numbers on it. So here are the numbers. Quantity, US dwarfs any other country in the world in terms of how many people it is testing per day. And it dwarfs it by a dramatic amount. Italy and South Korea, people say that their testing is extremely good. But the US is testing far, far more people per day than anywhere else in the world. And if you look at the ramp up, we were hardly testing anyone on March 11th, but now we're testing over 100,000 people a day. This is an incredible ramp up, and it should not go unappreciated. Where it gets tough is this testing per million people. The fact of the matter is, US is just such a larger economy and such a much larger country than any of these others that we can't get that per capita testing as high as a place like Italy. We're doing about as well now as South Korea, but we can't get that much higher than 400 per million people per day, which doesn't sound like a lot. But again, when you magnify that on top of there's 340 million people in the United States, that's a lot of tests that we're doing. It just becomes a logistical issue. And the quality of the test is very difficult to ascertain as well. So the way that when people talk about testing, they're usually talking about testing for the antigen. So the antigen is on the virus. So you get a swab, and hopefully the virus is on the swab. And then the swab gets shipped to a lab, and the lab goes through multiple processes in order to isolate that antigen and test for it. And this has multiple processes, and by the time it actually gets tested, there is so many potential places of interference that there's a 30% false negative rate. This isn't because it's a bad test. It's just because this is a fact of the test itself. This is how these PCR tests work. And so doctors understand this, but I don't think the rest of us really have an appreciation for this. So the quality of the testing is fine, but it's just, that's the best we have. We can't test something that's not demonstrated to a high degree within someone's body. And, when you're swabbing a nose and it's really in the lungs, it becomes even tougher. So what we're doing is we have a few different technologies that we can use to test for this. So we have the swabs that I was talking about, the PCR test. And you have more and more of these serologic tests, which test for the antibody. So antibody people are all excited about, but the antibodies are only generated by your body after you've had the virus. So it becomes it doesn't do well in actually saying, okay, you have the virus, we need to treat you accordingly. What it does is say, okay, you've had the virus, therefore you should have some immunity, therefore we are reaching some level of herd immunity. The fact of the matter is we're so far away from herd immunity right now that having an antibody test is nice, but it's kind of pointless. So we just need to continue to ramp up the number of tests that we give people, and we're going to get 30% false negative, but that's just how it works. Another test that we have now is an Abbott test. You get your results back in 13 minutes, but the thing is it can only do one at a time. So if you have a continuous flow process and you're batching 96 swabs every 4 hours, you're actually going to be able to process more tests than if you just test through this Abbott machine. The Abbott machine is great if you can go in and get your results right then and there. But the swabs, you can actually process more volume. It'll just be 4 days delayed. So there are pluses and minuses to all of these. And basically what the conclusion is that we just need to continue to ramp up all of these tests and give people a wide variety and large amount of all of these exams. So that's the first part, is figure out the testing. The second part is we got to stop the spread, or slow the spread here. And so this was an analysis that was done in February by the University of Washington, estimating what the potential impact would be. So I'm from Seattle, and when it snows in Seattle, the city shuts down. But that only resulted in a 50% reduction in social interaction, even when it snows in Seattle, which is worse than when it snows in Atlanta. So it's a big deal. And right now, I think we're about between 25 and 50% in terms of reductions in social interaction. So we haven't done as much as when it snows, but we're doing a decent amount. And you can see that in nitrogen dioxide emissions in Los Angeles. You can see that in these interstate speeds. Again, this is traffic in LA, and it doesn't dip in rush hour. And then you can see that in Seattle as well. So people are actually staying inside. You're seeing fewer people driving, and you're seeing fewer emissions. So that's a good sign. And we saw that in China as well. And even more importantly, is that we're actually bringing down transmissions as a result of these social distancing implementations. So this is a good sign for social distancing. It is a sign that we can flatten the curve, and it is a sign that people will actually do what they're told. So in this third chart here, you can see this R on the y-axis. This is how many people get it for every person who has it. So if I get it, how many people am I going to transmit it to? And the base case was about 4. That was kind of the central tendency. And then you go into self-isolation, that drops down by about 0.5 point. And then they closed the schools, and it was about another 0.5 point. And then they did, finishing public events. And then they just did the total lockdown. And you now see it drop down very, very close to that level of 1, which basically means that you're not having net new cases. Your caseload is not growing. You've flattened that curve. So we saw that in Germany, and we're seeing that in King County, which is Seattle. And so the black dot here is the transmission rate. So 3.5 people for every 1 person who has it. And you can see that dropping close to 1. And more importantly, what Facebook does is they actually see where you are and see how much you're moving. And it actually tracks very well to the number of cases that are actually to the transmission rate of the virus. So that's a good sign. It's a sign that social distancing actually does work, and it's a sign that you can flatten the curve. Obviously, the economic impact is another scenario that we still have to talk about. So you can see we are flattening the curve. China's a bit ahead of us, probably about a month or 2 ahead of us. Europe's about a month ahead of us. And so hopefully we can get there as well. This is on healthdata.org. This is a website that a lot of the politicians and policymakers like to look at. So that's number 1, is first of all, we got to reduce demand on the system. And we're doing a fairly good job of that. The second piece is we have to increase the supply within the system. And we're doing that by flexing resources, using things like hospital ships, opening the Abbott Center, even sharing ventilators. They have this Defense Production Act where you can say, okay, Pernod Ricard, you're going to make hand sanitizer, GM and Ford, you got to make ventilators. So these are things that what you can do to increase the supply within the system. And then you can also offload non-critical cases like elective surgeries. My sister actually works at a hospital in Los Angeles. She's a nurse. And she said that they've discharged all the oncology patients and elective surgeries and now just have COVID floors. And so obviously the critical ones, they'll keep in there, but the non-critical, it just becomes a COVID hospital. And so that's a way you can flex capacity to accommodate more COVID patients. And the final and the most, the area with the highest potential in terms of a market change is really improving the treatment and therapies, because when we're no longer scared to go out, when we're no longer told we can't go to the grocery store or can't go to a restaurant because we're going to get coronavirus, we need these drugs and treatments and therapies in order to have the confidence to actually do it. And so there are a few unproven therapies out there, drugs, azithromycin, hydroxychloroquine. There's remdesivir, which is an HIV drug that's being tested for use in this case. Expectations for that are not high right now among the analyst community. You could harvest antibodies from people who have already had it and potentially use them in a transfusion for people who are just contracted the disease, and then the arthritis drugs. But the real one is the antiviral, and that probably won't come until 2021. But the biggest thing is really the vaccine. Right now, there's 70 vaccines in development. I'm personally most bullish on the Johnson & Johnson vaccine. They said that they could ramp up to mass quantities in early 2021. And I think that's the timeline that I'm going to be operating on. Morgan Stanley came up with a very optimistic piece this morning saying that you could have vaccines for critical workers in the healthcare field as early as the fall, but probably not mass scale until early to mid 2021. And that's kind of the timeline that I would operate on as well. So if you do want to use the term get back to normal, and that's predicated under a vaccine, that's the timeline you should be operating under. Andrew, I'll let you touch on COVID here really quick.
Yeah, the only thing I would add is it's certainly been a unique period for our country. It's very wartime-esque in a lot of regards, and I don't say that lightly. But one thing that has been interesting, even over the last couple of days, I think Ben did a good job of laying out how much testing has ramped up, how much better we are getting at social distancing, things of that nature. But it has been a period in which over the last couple of days, even Democratic leaders have come forward and actually praised Trump for what he's done. So while we may not love everything he says at the press conference, and we may not love that he makes jokes about models and things like that during them, I think the job he has done, regardless of your view, has been pretty admirable. Today, Governor Cuomo said that Trump has responded quickly and efficiently to his needs in New York, which is praise that has sometimes been lacking. Gavin Newsom, who's the governor of California, former mayor of San Francisco, said yesterday that Trump has met, quote, every single direct request that he was capable of meeting. And he added, we have at least been able to rise above this partisanship. And he even in that interview really went so far as to say, I would be remiss and I'd be misleading the American public not to acknowledge the good job that he's done. So, it is at least nice to see a little bit of unity across both sides, regardless of which side you're on. But I do think, there's something to be said for the unprecedented nature of this challenge, but also the fact that the U.S. they're responding strongly, not only on the COVID side and the medical side, but also on the economic side, which I think you'll be going to here briefly.
Yeah. So I think the biggest thing on the economic side, biggest takeaway is that you've got a leaky bucket, and which works fine when you can keep filling the bucket with water. But when there's no more water coming in, and you still have the holes in the bucket, it's still going to leak. And so to give you an example, Delta had $12 billion of revenue last year, $10 billion of cost, made a nice profit of $2 billion. Okay. What happens when their revenue is going to be down 90% in the second quarter like they forecast? Well, that revenue drops from 12 billion to about 1 to 2 billion. Costs probably don't drop that much unless they cancel a ton of flights. And so they're left holding the bag on $8 billion in costs, which is a whole year of earnings. And so this is the type of pain that a lot of companies are dealing with right now. Delta is obviously a significant case, but there are a lot of smaller cases, especially in small business, that are having similar issues at the present time. Tom, I want to get you on to talk a little bit about the impact this is having on the fixed income markets, because we talk a lot about stocks, but I want to lead off with treasuries here and the fixed income markets, because this is where we're seeing the real liquidity crisis really come to the fore.
Thanks, Ben. So to give you an example of how extreme the liquidity crisis hit the bond market, this chart basically shows the ratio of municipal bonds to treasuries. And as you can see, all the way back, it doesn't change very much. Typically, your municipal bonds are trading about 90% of treasuries. And the reason they do that is because they have a tax-exempt kicker on them. So if you're buying a treasury that pays 1% and is a 10-year treasury, buying a 10-year bond at 0.9% may seem like you're getting less bang for your buck. But if you're in a 30% tax bracket, your actual yield on that municipal bond could be significantly higher because you're skipping out on the federal taxes. And if you're buying a bond in your own state, skipping out on the state income tax as well. Basically, as we saw the crescendo in the fall in the stock market, we saw that leak into the bond market as well. And as you can see, we saw that ratio of AAA municipal bonds really spike up. And the reason for that is, in any given year, only about 10% of all AAA municipal bonds will trade. Some of these bonds are issued by, say Marietta issues bonds to build a bridge. They may go into, a bank's balance sheet. They may go into a trust, and they may not trade for years. And so the price is a little more ambiguous than you would have on a stock. And so when you suddenly see a flood of bonds to the market, you see the pricing fall away. And that's what we saw here. For a period of a few days, we were able to buy municipal bonds at prices with tax equivalent yields, in the 8% range, which is like equity-like returns on what would be considered some of the most vanilla bonds and vanilla investments you can buy outside of treasuries, which are federal bonds. And why that's so significant is it's pure panic. You don't see that very often. It's been years since we've seen these kinds of ratios, and it presents a unique opportunity, but it shows you that the liquidity issue is supreme. And so we've seen that come back a lot. We've seen the Fed step in and say, hey, we're going to buy municipal bonds. We're going to buy corporate bonds. But in terms of what I would call a crescendo of panic, when people just start firing out of things that would be normally considered very, very safe just to get to cash, just to get out, we saw a real peak in prices, real peak in yields, and a real drop in prices at an alarming rate. And we used that to our opportunity, or to our advantage. We took advantage of that, bought some opportunities on the muni side. And we've already seen that get erased by the Fed's move, even in the last few days. And on the next slide, you can see that we had the same effect in junk bonds. And really, for the last few years, people have been buying bonds just to get the yield. We've been chasing yield for years now because interest rates have been so low. And so the balance of what I would really consider the seesaw of risk reward has been skewed in a bad direction. And for that reason, we've really avoided buying a lot of corporate bonds over the last few years because there's just a glut of them, and they're trading at levels that we would say, if we got in a scenario like this where suddenly corporations were on the rocks, you're going to be looking at a situation where you're holding a bond that's got a loss or has much higher default rate risk than you previously seen. And so you can see here, we basically went from getting about 2.5 times the treasury on BB bonds, all the way up to 7.5%, 8% in a short period of time. And if those rates stay there, you're going to be looking at a loss on your bonds for really the duration of your hold period, assuming they even pay off. And so the liquidity risk has been exponential. We're seeing a flood of bonds in the market. We're not seeing any buyers. We're seeing people eschew corporate debt at an extreme rate, and we're happy not to be large net holders of corporate debt. But we may start dipping in there because we're starting to get to a point where we're finally seeing the seesaw flip in the other direction, where you're seeing there is some value to taking a little bit of credit risk for the first time, but we're not going to be reaching because we think there's going to be a lot more defaults going forward than there have been in the last few years.
Thanks, Tom. I think the big takeaway here is that if you look at that level in terms of how high the credit, how high the spreads went. That's kind of textbook. That's what a financial crisis is. That's what happens when there is no one willing to buy something. That's when it goes, we call it no bid. There's no one willing to buy it. It's like having a house that Zillow thinks is worth X, but it's only worth X if someone's actually willing to transact at X. If everyone's staying inside or no one's buying houses, then you can say what it's worth, whatever you want it to be, but it's not, because no one's willing to buy it. And so that's what we saw in not only stocks, but also corporate bonds, and, as Tom talked about, municipal bonds as well. Goldman actually even had to step in to shore up 2 of its money market funds. So money market funds should be extremely liquid. Goldman had to come up with $4 or $5 billion of its own money and actually save the 2 money market funds from going below what they call breaking the buck, which would have been, last time that happened was 2008. You saw kind of a bizarre market is these repo markets, but a lot of times that's where a lot of these financial concerns manifest themselves. And so we saw some major disruptions in repo markets as well. All this to say, it needs a response. And there's 2 types of responses. One is they differentiate, which is the fiscal side. And this is all the money that the Treasury is spending. So this is what the politicians are doing in Washington. This is what the House of Representatives are doing. This is what the Senate's doing. This is what the president's doing. Okay. And that is, and really there's a lot more to it than this, but the 3 biggest pillars are the Paycheck Protection Program, which basically incentivizes business to keep people on the payrolls. You've got a boost to the unemployment payments, which people don't really talk about, but that's a big deal. That's $900 a week that people are getting from unemployment that they'd normally be getting $300 a week. So that's a really big deal. And I think that's actually bigger than the third piece, which is just direct deposits into your bank account from the IRS. And that's $1,200 for adult, $500 for a child, up to $75,000 for single, up to $150,000 if you're married. So this is the $2 trillion package that Mnuchin was talking about and Pelosi was talking about, and they're going to do a phase 2 or phase 3, or I think they call it phase 4, but they're doing more phases of this. But the second one, so that's the fiscal response. And then what they call the monetary response is the money printing. So this is we talked about things going quote unquote no bid, no one willing to buy. Well, this is what the role of the Federal Reserve is. So the Federal Reserve is the buyer of last resort. So if you think back to It's a Wonderful Life. So Jimmy Stewart had that bank, and there was the run on the bank. Everyone was trying to get their money back. That doesn't happen with the Federal Reserve, because the Federal Reserve will step in and actually guarantee deposits, et cetera, et cetera. So this is basically what the Federal Reserve does. And so they're buying everything. They're buying US government debt, treasuries. They're buying corporate debt. So they'll buy Apple bonds. They're actually buying GE bonds now, Johnson & Johnson bonds, all this debt in the market that we saw no one wants to buy. The Federal Reserve is stepping in to buy it. They're stepping in to buy municipal bond debt, and they're stepping in to buy, as they do, consumer loans. They're stepping in to buy mortgage-backed securities. They bought $500 billion of mortgage-backed securities in the last less than a month. And to put this in context, they were buying $45 billion a month a few years ago when they were doing the last round of QE. So this is 10 times as big. They're buying student loans, credit card loans, auto loans. They're buying the AAA tranches, which is supposed to be clean. But this is what they're doing. And basically, when no one is willing to buy, there needs to be liquidity in the system. Otherwise, you'll ultimately go to the bank, and the bank won't have the money to give you. And this is what we saw when a bunch of companies pulled their credit lines at their banks, because they were concerned that once the quarter ended, the banks would freeze up and wouldn't lend them what they had on their credit line. So this is why you saw everyone pull their credit lines. Good companies pull on their credit line. Starbucks pulled its credit line because they wanted to make sure they got their capital before the next guy did. And that's what a bank run is. And that's what the Federal Reserve has tried to stop. And they've done it okay. But obviously the financial disruption has been huge over the past month. So they're doing okay about it, but it needs to continue. And I think the Federal Reserve balance sheet will go from about 4 trillion to over 10 trillion, probably in less than 6 months at this rate. So this is the money they're pouring at this. So to sum up with COVID-19, we got a contagious, deadly virus. I think that science will help solve the problem longer term, but in the near term, we got to figure out how to treat everybody and how to get everyone tested. And we're doing that. And social distancing is helping, but it requires this, what I call this economic chemotherapy. And that is, we are giving ourselves poisonous drugs. This is economic poison, what we're doing. And then we have some care, we have some doctors and nurses trying to take care of us and making sure that the economy, that this poison doesn't completely kill the economy. And so that's what the Federal Reserve and Congress are trying to do. So that's COVID-19. Let's talk a little bit more about the shutdown and what the implications that's having on the economy. So Ed Bastian, in a SEC filing about a week and a half ago, said, you guys are doing a great job taking leaves of absence and collecting unemployment instead of working for us, but we need more volunteers. At this point, they had 30,000 people who left the Delta payroll in order to collect unemployment. And he said that's not enough. Tough times. And this is why. People are talking about 20-30% GDP declines in the second quarter, and this is one of the reasons that we think that's going to happen. In China, which locked down January, February, came back a little bit in March, you saw massive declines, 40% in construction, 35% in home sales, 20% in retail sales, massive declines in production. And we're a service-oriented economy, which is going to be more hit by the disruption in the service business than in the manufacturing business. You could see this happen in the nitrogen dioxide levels. Things would just shut down for a full month after they would normally pick up. Now, if you're bullish, and here's the bullish narrative right now, once you get over this hump, you snap right back. And this is what we saw in the Chinese manufacturing index. The problem with this is, how manipulated is it? How isolated was the issue in China? Was it just in Wuhan? And was just Wuhan locked down and everything else was doing okay? In that case, things snap back. And you could see that in the services index as well, the non-manufacturing index. So this is the bullish narrative, that as soon as we're done with lockdown, we're right back. The problem with that narrative is that it assumes that, one, China actually did eradicate the disease. Two, it was isolated to Wuhan. And so, right now we have it everywhere. So it's more difficult for us to lock down and immediately come back everywhere. And then three, what is the data actually believable? The Chinese government has manipulated data in the past. Is this a manipulated data to say, oh, don't worry about it, we're in the all clear zone? Or is this actually real? And I think there are real concerns about the veracity of this data. Certainly the Chinese stock market doesn't believe it. Chinese stock market is still trading well off its highs. And so let's look to Europe. What's happened in Europe? Well, right now, we know China's about 2 months ahead of us. Europe's about a month ahead of us. Europe just had its first big down month in data. Manufacturing declined significantly, but services activity declined by far, far more. This is a historic decline in services activity. And usually oftentimes the services side of the economy actually is more robust. But obviously in this environment, you're not partaking in many services. You're not going to restaurants. Manufacturing can continue to an extent more than services. But in the services side of the economy, you're just seeing mass shutdowns. And so that's the concern when you're talking about the US. And then, of course, we've seen all this in the headlines. 10 million new jobless claims in the last 2 weeks. That's an astonishing number. The employed labor force in the United States was about 160 million coming into this. So you just wiped off another 7-8% of that. And I think you're probably going to wipe off another 7 to 8% of that in the next 3 to 4 weeks. So these new jobless claims keep coming, and there continues to be less and less of a stigma from companies to lay off employees. The more companies that lay off employees, the easier it is for the next company to lay off its employees. That's kind of how it works. The pride of not firing an employee starts to lessen as soon as you see the drip, drip, drip of your net loss line go higher. So this is the data we've seen so far in the United States. Again, it hasn't really hit the data yet, but expect this to decline. Expect the services to decline a lot. That'll probably go down into the 30s at least. We saw in Europe, it went down to 26 in 1 month. So don't be surprised to see that fall substantially. And again, this is why we think that GDP growth could fall 20, 30% next quarter or in the current quarter. You're already starting to see it in some employment indicators. Again, this could get significantly worse, especially with the oil job losses that we've been seeing, and on the services side as well. So wanted to give a couple case studies really quick of what we're seeing. Punch Bowl Social is one. They have one location at the Battery. Cracker Barrel actually bought a significant stake in them last year. Punch Bowl very quickly said, furloughed, just got rid of all of its employees, shut down all of its restaurants, and is now in default on its credit line. I mean, this happened in 2 weeks. It's amazing how quickly a lot of these restaurants, especially a lot of these restaurants that are trying to get growth, it's amazing how quickly that as soon as they stop that revenue coming in, they can't make their lease payments, they can't make their debt payments, and they're in a world of hurt. And that's the case for Punch Bowl right now. Here's a quote from Delta. Again, we referenced this earlier. 30,000 employees have volunteered for unpaid leaves of absence, but they need more volunteers. So this is the little guy taking one on the chin for the big guy, which speaks a lot to those people, quite frankly, and they don't have to do that at all. But it also speaks to the world of hurt that the airlines are in, and Delta is in one of the better positions of some of the other airlines. American is in a much worse position. Carnival Cruise Lines said that, and this is one of the most salient topics for us going forward, is that this disruption may impact things a lot more beyond the containment of this outbreak. They've never experienced a complete cessation of our cruising operations, and they just can't give a prediction. And again, we talked about the markets don't like uncertainty. Well, this is uncertainty writ large. And the people who still have jobs are often taking pay cuts. So we hear about a lot of people taking just wage cuts, Occidental Petroleum, Cheesecake Factory, GM, Hilton, but then I also have bonuses and profit sharing profit sharing in a lot of companies. Airlines are included in that. Airlines often compensate their employees through profit sharing schemes, and a lot of small businesses do, and oil services. And that's going to take a massive hit with this because there aren't going to be any profits to share. And so this is not only impacting jobs, but it's also impacting the amount that people get paid for those jobs. And that's a hugely significant piece that I haven't heard a ton of people talk about yet. I want to bring Andrew in to talk a little bit about some anecdotes that he's heard on the small business side over the last week or two. And things just seem to be happening extremely quickly at all these companies.
Yeah, thanks, Ben. A couple that I'll mention too on the slide, and one additional one that kind of developed over the weekend. But got a good friend who works for Mopar. They are the parts supplier for Chrysler, Dodge, Jeep, all those folks. And he's on the sales side. He's down in Florida, and he said that they just got handed out 20% pay cuts for at least the next 3 months. And the other thing for him is a large portion of his compensation is tied to commission. And he said, production tied bonuses, things like that, that's looking really bleak. Quotas are being kind of thrown out the window, which in a way is a good thing, but also means so are bonuses. So huge challenge there for a large auto parts supplier. In financial services, specifically investment advisors, what we do for a living, it's been really interesting just talking with some folks that do what I do for a living and hearing how their business is adjusting. A lot of them are having to take advantage of the Paycheck Protection Plan. But others still are actually looking at laying people off. You don't typically think of, this being the first industry that's impacted, but a lot of firms are really heavily reliant on business development professionals. They're highly compensated employees. They're, the idea is you pay them a lot of money and they bring you a lot of business. But right now, they're having a really hard time meeting with people, bringing in new business, and those people are some of the first to go. So definitely hearing that even within our, small section of the world on investment advice. And then the third one, which is not on this slide, was actually talking with a guy that lives nearby recently, and he works for a large sales company. They sell lots of furnishings, rugs, things like that. And he's, reports directly to that company CEO. And he said they're definitely getting closer and closer to capitulation on layoffs. He said, you have sales representatives from buyers that you talk to all the time, and all of a sudden you talk to them on Thursday and Friday, they're no longer with the company and they've been there 20 years. He said that really starts to wear on your mentality. And he said, for the longest time, our CEO has said no layoffs, no layoffs, no layoffs, even throughout this, even as numbers dipped, things like that. And he said, but now, we're kind of working on our back burner on a plan for if there are layoffs, what's it look like? So a lot of businesses are really struggling, even some that you may not think of, at the forefront of your mind, but that's kind of comes hand in hand with a potential 20 to 30% decline in GDP in one quarter.
Yeah, thanks, Andrew. So I think the big takeaway from this, what is the implications of the shutdown? To use Winston Churchill's quote, it's not the end, it's not even the beginning of the end, but it's perhaps the end of the beginning. Data is going to continue to get worse. All these anecdotes that we've seen over the last week, 2-3 weeks, still have to filter through to the data, still have to filter through to the jobs numbers. So although we have some potential optimism given China's rebound, there is definite reason to think that Europe and the US is going to take longer. And data is probably going to get a lot worse before it gets better. So that's a sobering, unfortunately, reality that I see. But we got to keep moving forward. So how do we do that? I think a lot of people want to anchor to where we were. But there's a danger in that because we don't necessarily want to get back to where we were in January. We saw that it wasn't the ideal situation. Yeah, the market was good, but that was probably going to correct anyway. And someone was probably going to buy the dip and it wouldn't have been down 35%. But I think the danger that you can make in investments is thinking you want to get back to where you were. And I think that we often look at things through rose-colored glasses, especially in the rearview mirror, and especially when things are bleak. When we need to focus more on dealing with what's in front of us, dealing with the present and getting through. So instead of getting back, let's talk about how do we get through this. That's kind of what we want to do over the next few slides. So I think the data is going to get worse before it gets better. We're still going to have, even if we get through this coronavirus, we still have Brexit negotiations are going on right now on Zoom or some other video conferencing. We still have an election in the fall, and we still have global concerns with coronavirus. I mean, the real concerns about India, which has been on lockdown, Indonesia, which there are concerns that they aren't reporting about all their cases. And that is not a health system that's poised to handle that nearly as well as the US. And the US has struggled with it. So things are even tough on a global scale, on a humanitarian scale, on that aspect as well. So this is one of the slides I think that most people want to know about, and that's what does GDP actually do? And so the consensus on Bloomberg right now is that GDP is going to be down 25% in the second quarter. That's incredible. I mean, in the financial crisis, I think we were down 8% in our worst quarter. And so now potentially be down 25% in the second quarter. That ranges from -15 to -35. And so that's just incredibly significant. So that's going to take a long time to get back from. And if you add up all those numbers to the right of the 25.1, you probably get back to normal in sometime toward the end of 2021 and into early 2022. That's kind of the consensus out there right now. I like to be optimistic. I'd like to think that there would be a chance that we could have that quartile 3 scenario, the optimistic scenario where we're not down as much and we do snap back. But I think there's the realistic scenario is to just take the average. I'd like to think that we have a little bit more of a snapback, but the fact of the matter is, if you were going to go to the restaurant 10 times over the next 3 months, you're not going to go 20 times the following 3 months. You might go 10 times, but the growth, the lost output might not be made up for another couple of years. So this is a thing that we have to deal with. And again, we just want to get through this. We shouldn't anchor to getting back, because the getting back scenario is a longer scenario, and you can definitely make poor investment choices over the next 2 years. I know certainly I can. So what does Jamie Dimon think? A lot of people put a lot of stock in what he says. Him and Warren Buffett really are kind of the grandpas of the market right now. They can tell the market what to do. They can prognosticate on things. And he says that at a minimum, this is a letter to shareholders. He said, at a minimum, we assume that it will include a bad recession, which we obviously think is going to be the case, combined with some kind of financial stress similar to the global financial crisis of 2008. And, this financial stress similar to the financial crisis of 2008. 2008 was unprecedented really since the Great Depression, and needed a record amount of money printing. And we've already seen an additional record amount of money printing early in this financial crisis. So I would agree with Jamie Dimon, and I think that the banks are in a stronger position, but it will be a one that we have to get through. It's going to be over a period of quarters, I think. So that's the path forward, but we got to keep on going. And the way that we do that at Narwhal is starting from the asset allocation. I think at these points in time, and I think Andrew can weigh in on this one. At these points in time, I think the tendency is to really follow the market price, when really the asset allocation is based on your life situation. And this is the reason we had too many bonds last year, and this is the reason we have too many stocks right now, because it's based on where you are in your life situation. We're not trying to time that market. We're trying to build an asset allocation that's appropriate over the longer term for you.
Yeah, thanks, Ben. And I think that's been probably the biggest challenge for us really over the last two to 3 months is just staying disciplined. And I think at times if you're a client, that can sound like a broken record. But when we set those asset allocation targets, we try to do so when cooler heads are in the room and when we hope those cooler heads will prevail in times of volatility. And last year it was, don't get us wrong, it was a struggle to constantly be trimming stock as the market ran up more than 30%. And that was a challenge. And it's a challenge to be buying stock when it's low and then seeing rebounds and trimming a little bit even now. But that's really what's crucial for us. You know, we kept getting the question, where's the bottom? Have we seen the bottom? And the reality is we don't know. We hate to not have all the answers, but also if you're a client, you think you're paying us to have all the answers, then I don't know where you heard it, but it wasn't from us. We're here looking for individual opportunities that make sense. And when we do that, there's certainly things that get challenged. When we look at any particular investment, especially on the equity side, we pay great attention to what we consider to be the mosaic. And that's kind of a balance of the macro environment, which you can kind of see on this slide. We pay attention to the moat. You know, can this business do something that other people can't? But we pay a lot of attention to management. And I think this has been a period where we're really listening with our ears as open as they can be to what management is saying from all these companies. And we're really having to reevaluate the macro scenario for a lot of businesses. So that's certainly been a challenge. It's certainly been rather fortuitous that we've been underweight a lot of sectors like energy. We don't own a whole lot of oil. So that's been pretty helpful. And it's certainly been a benefit that we don't own a whole lot of restaurant stocks and things like that. But really what we're trying to find is attractive opportunities. We're trying to stay as disciplined as possible. And I know we sound like a broken record, but that's what we do. That's what we say we'll do. And if we can do that, we do remain confident that we'll come through this, whatever through this looks like. We'll come through this on the other side and be grateful that we stayed stuck to our guns.
Yeah, I think that's helpful, Andrew. And I think the big thing is, you know, we sound a little bit dour on this call, but that doesn't mean the stock market won't rally. For instance, last year the market was up over 30%, and economic growth actually slowed versus the previous year. So even if you get the growth right, it might not get the market right. And so what we want to be in is we want to be positioned well to succeed and outperform in down markets and up markets. And that's how we want to be positioned within each asset class. But time in the asset classes, you can call, you have to get everything right. You have to call every single recession exactly right. Otherwise you'll be calling the recession and you'll have missed out on the 30% of gains that happened last year, and then maybe come in back in this year and then go down. So coming in and out is where it hurts. Having said that, right now is within each asset class is actually one of the few times that active fund managers should outperform. And the reason is that they tend to outperform in periods of high volatility. So you can see on the graph, they don't outperform much, but even active mutual fund managers will tend to outperform in these periods of higher volatility, because even the bad ones should be able to discern a company that's about to no longer exist from one that should be able to succeed, versus an algorithm, a blindless ETF, a blind ETF just buying everything. So this is where active management actually, at least based on this mutual fund data, tends to work. On the fixed income side, I'd like to have Tom weigh in and talk a little bit about what he's seeing there in terms of fixed income strategy going forward.
Thanks, Ben. So a great way to explain what it's like to manage fixed income is a lot like playing whack-a-mole. So there are going to be different opportunities at every time in the market. The question is, are you quick enough to get to them before they disappear? And so these two charts are kind of telling as to where the value was pre-crisis and where it is now. So if you look at the left chart, the blue line is the treasury curve and the green line is the municipal curve. And at the time, what we were saying is, you know, we can buy a 3-month treasury and get paid 1.6%. And in 3 months, who knows, rates could definitely change. But right now we're getting, outpaced performance by buying essentially a risk-free asset. So you can see that there, the difference between buying a 3-month muni, which is essentially no return, and then buying a treasury, which is risk-free. That was the whack-a-mole then. We could jump in and we could buy treasuries that were very short, risk-free. We could basically punt and play defense because right then there weren't a lot of opportunities. We've basically seen that flip. So you can see what's happened is the Fed cut rates to zero and the treasury curve has collapsed. So it's fallen all the way down below the municipal market. And so where we see opportunities are in short-term municipals and in intermediate to long-term municipals. So that 7 to 10 year range is where you start to see value, and inside of that 5-year range, you can see the chart below shows you the spread between the two. So where a lot of people are buying right now is that 3 to 5 year range. And we think that either going shorter or longer is really the way to get the most bang for your buck. And so right now, and even in the last couple of days, this spread has collapsed. We've seen the Fed file in, they're saying they're buying everything. And so we've seen already this opportunity starting to squeeze out. So really what we're preaching right now is our strategy is, now with this limited window, we need to be reaching for these AAA bonds. We need to be looking for the stuff that is the vanilla ice cream of investing. We're basically getting it at all time, excellent spreads. And, just like the treasury opportunity collapsed on the front end back in February, that's where we really want to go now is say, hey, listen, we can buy these bonds, they're clean, they pay tax-free income, but we can get them right now. But, like whack-a-mole, it's about to go away. And then in terms of the strategic keys, really just to harp on that, if you look at the default rates over here on the right, you can see the default rate on a BBB municipal bond, which we considered, in the lower rungs of investment grade, you're looking at a 1% default rate, which is actually lower than a AAA corporate. And so I think that really rings true right now, which is that we're going to see a lot of these corporations that previously were very clean, right? I mean, Delta was making a ton of money and now they're not making any money. And we're going to see the default rates on companies like that start to skyrocket. And so we would much rather be buying at historically cheap levels, some of these clean bonds that have essentially no default risk. Once you start getting into the A, AA, the number of bonds that default in the muni space are very small. And the ones that even hit the headlines like Detroit, Puerto Rico, a lot of those bonds don't actually ever default, but they get a lot of headline risk and that pushes prices down. And that's not what we're looking for either. We just want to be crisp and clean and no caffeine, looking for opportunities along the curve, as long as they're there. But it's my suspicion now that the Fed has come in and started buying all these things that they're going to try and drive people out of these types of investments and back into more risk assets like the market to try and prop up prices, get people back, buying stocks. Because, why would you be buying a stock where your expectation is to make 8 to 12% when you could buy a municipal bond that's yielding you tax equivalent of 8 or 9%? So they kind of want to take that opportunity off the table, fill in that liquidity gap, and kind of get everything back into homeostasis. And so we're trying to jump in there as fast as we can, buy up these bonds. In the IRA space, we want to be buying taxable munis. They don't have that tax exempt status, but they're backed by the same credits. So we think there's opportunity there, especially in the short term on taxables. But that's really where we're targeting. We're trying to be very aggressive right there, right now, because I think that what we're going to see is this is going to evaporate. And then once the corporate gyrations begin, there's going to be more opportunities there in the long term where we can buy very clean companies that are getting thrown out with the bathwater as we see these major companies really hit the rocks with their drop in revenue.
Awesome. Thanks, Tom. So what are the takeaways today? Basically, we've established COVID-19, more similar to the Spanish flu. I think we're managing the health crisis. I think we're seeing peaking cases. Financial crisis has been instituted, government instituted through social distancing, and the data is going to continue to get worse before it gets better. But I think it's important in these moments to remain disciplined, not get emotional, not chase price. And I was reading a book over the weekend or last week, actually. And I think that there's a lot of parallels between getting back and kind of being the hero and who calls the bottom and who calls the top, who calls the bottom, and being that hero. And I was struck by this quote, so I'll say it here, and it's in the slide deck we'll end up posting, but it appears that some Major League Baseball players, in a quest to play not just well, but at a Hall of Fame level, took steroids and other drugs. As a result, their bodies are more broken and their reputations more sullied than if they had been willing to be good rather than great. The very things upon which these people were building all their happiness turned to dust in their hands because they had built all their happiness upon them. In each case, a good thing among many was turned into a supreme thing so that its demands overrode all competing values. And I think when we think back to where the market was on February and your account level and my account level and everyone's account level, that's something that, was and hopefully will be again, but that's not something that we're anchoring to. We're focused on getting through this, taking advantage of those opportunities that are in front of us, and trying to be good rather than be the heroes. And with that, I'll sign off for me. Andrew's going to close us here, but thanks all for listening.
Thank you, Ben. Great job as always. And I'll close with a couple comments. I really just want to thank everybody that's on the Narwhal team, so to speak. Hopefully you enjoyed the presentation. I've said this often, and I speak for Matt as well. I think we've got some of the best and brightest minds in our industry. And I say that because I'm proud to work alongside them, proud to have guys that don't think they're the smartest guy in the room, even when they're socially isolated. But, Ben's work has certainly been invaluable. So is Sam's. Tom has been such a leader on the fixed income side, such a great asset to us since we added him. So thanks to those guys. The client service team has done an absolutely fantastic time. If you're a client, I'm sure you have interacted with them over the last couple of weeks. But Andrea Walker, Melissa, who we mentioned earlier, Luke Burton have done just a great job and a really challenging time to interact with clients, and they've really stepped up to the plate. The accounting team, you don't hear from them much, especially when tax deadlines get pushed back, but Dean Wardlaw, Jonathan McKay, Sylvia Priest, they're still working away, trying to get these things done as quickly as possible. And even kind of our back office and support team. Alyssa has done so much to get phones ready, getting things like that. My son Martin is making a cameo right now. Jonathan Hicks, kind of the unsung hero of the office. He does all our data integration. He's actually managed a huge portfolio center accounting software transition during all of this. And he's handled it like a champ. He vetted the new company. He's handled the migration. It's all gone really smooth, even with all this chaos. So thanks to Hicks. And a guy that some of you have met is Greg Moyer. He's interned and worked with us in different capacities over the last couple of years. But really, we were really blessed that he came on full time to manage things like IT and operations about a month before all of this hit. So he's really stepped up to the plate. So we're really grateful for them, and certainly grateful for the most important part of the team, which is the clients. I don't say that lightly or facetiously. You guys have been awesome. We appreciate your questions on these briefings. We appreciate your emails, the texts of encouragement, the trust that you guys have put in us. We do not take it lightly. We labor over these decisions. We lose a lot of sleep. We hope that means you get a little bit more. If that's ever not the case, make sure you're reaching out and talking to us. We're always a text or a phone call or an email away, but we appreciate you guys. As a reminder, we'll be doing these calls much shorter, every morning at 8:30, every afternoon at 4:30, and we appreciate y'all. We'll wrap it up there. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.